Good morning, everyone. I'd like to welcome you all here this morning, and on behalf of the Association of Corporate Treasurers, to another one of our interesting webinars. For those that don't know me, I'm Artemis Galatis, and just a little bit about ACTSA that I'd just like to share with you. We are very excited. In about 2 weeks' time, we will be launching our education program with the University of the Free State Business School, and we have 15 or 16 entrants starting the new corporate treasury program, which will just give a bigger insight and understanding of really what treasury in a corporate is all about. It took a lot of effort on our part, and it's not an academic, just only from an academic point of view. There are real life treasurers who actually participated in this program. And also just about our next event, which is on the 21st of October, and that will be a co-event once again with Standard & Poor on ESG finance. But back to today's proceedings, I really would like to thank our sponsors today, Deloitte and ACTSA, who put in a lot of effort into getting this panel discussion together, and I must thank you very, very much. Just a little bit of housekeeping rules for this morning. Please ensure that all your microphones are on mute. If you would like to pose any questions, please enable your chat, your chat on Teams, and pose your questions there, and they will be answered by the pertinent people. Just to let you also know that this is being recorded, and yeah. So really, over to the panel, to Monique, to Ovi, Jay, Kim, Mark, Joe, and TJ. Enjoy the morning. And also, if there are any further events you'd like to know about for ACTSA, please go to our website.
Thank you, Artemis. If I could start off by introducing the ladies and gentlemen on the panel. We've got Monique Dewell, a director in the Treasury Advisory Services Division of Deloitte Africa. We've got Ovi Stwetcha, the Pan-African Head of Short-Term Finance at ACTSA Corporate and Investment Banking. We've got Joe Mitchell-Murray, a director in the Restructuring Services Division of Deloitte Africa. We've got Jay Hanemoon, the Head of Transactional Banking Solutions at ACTSA CIB. We've got Mark Schwartz, an Associate Director within the Treasury Advisory Services of Deloitte Africa, and also a board member of ACTSA. We've got Kim De Buck, an Associate Director in the Financial Risk Advisory Services of Deloitte Africa. And finally, I am TJ Quarry, a Senior Manager in the Treasury Advisory Services of Deloitte Africa, and I will be your moderator during the conversation today. Thank you, ladies and gentlemen on the panel. We're all looking really forward to being enlightened by what you have to share. Okay, so let's dive right into our discussion. The theme of our conversation today is cash management during a COVID-19 recovery period. And I believe everyone in attendance can agree that the cash flow forecasting function is a very essential tool and is one of the bedrocks of effective cash management and planning. Let's go back to the basics and understand why it is so vital for any business to not only forecast its cash flow, but to be purposeful about trying to do it as accurately and as possible. Joe, would you like to get us going with this?
Thanks very much, TJ. So the cash flow forecast is a powerful tool for managing a business particularly where cash or liquidity is constrained. It provides insight into the lifeblood of the business, which is cash. And that insight highlights vulnerabilities and strengths. The cash flow forecast enables informed decision-making, and with the appropriate visibility, allows for proactive rather than reactive decision-making. It allows for those crunch points to be identified well ahead of time, such that sufficient mitigating actions can be taken, which would include timely conversations with lenders. But not only is it useful for internal decision-making and highlighting those periods of constrained headroom, but it also provides an insight for third parties into how well you know your business. What are the cost drivers? What is the cash conversion cycle, for example? I recall assisting a business with their cash flow forecast, and they had one line for revenue receipts. When we unpacked that, there were multiple revenue channels, whether it was agents, merchants, online, cash. And that made a fundamental difference to the forecast and showed new periods of intra-month concern. We typically advocate for what we term a rolling 13-week forecast, as at the very least that should cover a full operational quarter and allow for the full expenditure and revenue cycle. However, the trick is to ensure that there is sufficient granularity in the forecast. And often that does require, though, an 80-20 principle is also applied, as otherwise the benefit you derive from the forecast is actually lost in the time taken to complete it if you go into too much detail. Back to you, TJ.
Thank you, Joe. Over to you, Mark. Would you like to share some of your thoughts around why cash flow forecasting is so crucial to any business?
TJ, thanks. Good morning, everybody. You know, there are a number of things that are worth considering. I think the first one is that proactiveness is going to improve the level of pricing that you're going to achieve. I think we all know that if you have to go to the bank or to your lenders in an emergency situation without a good cash flow forecast, you're immediately going to be on the back foot in terms of pricing. Whereas, you know, a long lead time with good forecasting gives you the time and the space to find the right facilities that you need and to do so at the right price. And I think, especially in an environment now where cash is relatively cheap, good forecasting ability and the ability to be able to understand what's coming could lead to some pretty advantageous situations in this particular COVID environment. I think also having this better forecast accuracy would also reduce your interest and foreign exchange costs, especially if you think about understanding where you might have inflows into your business, where you could reduce your debt load. That would also be of assistance. People who can foresee and navigate these risks, especially in stress times like these, which we've seen on odd occasions over the past few decades, will understand that the ability to have a handle on what's going on in your business really does give you a considerable leg up. Thanks, TJ.
Thanks, Mark. Ovi, an important point has been touched on about how cash flow forecasts play a very key part in conversations between the treasury function and their bankers. Can you elaborate a bit on how it can affect key treasury elements such as funding decisions?
Yeah, thanks, TJ. TJ, I think the fundamental point around focusing is the accuracy of the information. You would know that an accurate cash focus provides a sense of when you're going to need that funding that might be needed by the business. You know, and it also gives you a view of what surplus funds you have and how best to place those surplus funds to actually get a good yield out of them, especially in the time where you want to get as much return as possible on your available funds. So it's important to have that. So having accurate information allows for better planning and provides confidence to the business first and the treasury function in a big group, but also to the banks, because the more we believe the information you're providing and the more accurate it is, the better our decisions are going to be as a bank. And I always say this: it is not always about painting the best picture for the bank, but it's really about painting the most accurate picture, because this information that you're sharing and on this cash focused, it actually is the basis of the decisions that are being made by your funders. So it has to be as accurate as possible. More often than not, though, in any business, there are entities that are getting more cash at a time and others that are not getting cash or that are using the cash. So forecasting helps to manage those differences within the business. It helps also to manage the unforeseen shortfalls that you are then able to make the necessary arrangements, you know, to kind of close those. You know, but even bigger than that, I think if you have a clear view of your cash flows and your forecasting, it also helps you to harmonize your relationships with your suppliers and buyers. You know, and having functional data and data points and near perfect forecasting helps in managing and making sure that your cash flow and your cash conversion cycle, in a nutshell, is actually managed in a much better way, and you then optimize your cash conversion cycles, as it were. Thanks, TJ.
Thank you, Ovi. Now, the COVID pandemic has taught us that the best laid plans sometimes go awry. And with this in mind, let's talk a bit about some of the challenges, pitfalls, or common mistakes that can be seen in the cash flow forecasting process and exercise. Starting again with you, Joe, if you don't mind sharing.
No problem, TJ. So I spoke previously about the need to understand the cash conversion cycle so as not to have too summarized a view in the forecast, as it really does lose meaning. And I recall specifically a multi-billion rand entity where we were involved in reviewing the cash flow, and it really consisted of 5 lines, and 2 of those were, opening balance and closing balance. So when it's too summarized, it really detracts from its usefulness. So for me, that is one of the pitfalls. Bottom-up forecasting as well is typically very manual. And that means it can be time consuming, and there are many iterations to get it right. And typically these are Excel-driven models, largely because it is the medium most readily available and that businesses have access to, and doesn't carry a hefty price tag in terms of a new piece of software to assist with cash flow forecasting. And Avi touched on the importance of ensuring that you're not painting the best picture for your business. The assumptions need to be realistic. You want to avoid that proverbial hockey stick in forecasting. The challenge with presenting a hockey stick is it immediately detracts from credibility. And that means there's a loss of confidence in the forecasting process. So, the forecast is really only as good as the assumptions that are used, and the ability to interrogate those assumptions such that it is dynamic and you can play with the different variables and understand what scenarios look like and understand the sensitivities. And perhaps one of the scenarios is all the stars align. The realistic scenario would be tempering some of those variables and presenting the realistic cash flow forecast. For me, having the ability to map scenarios, understand sensitivities, see the drivers of different variables, boosts confidence in the process. And ultimately, that for me enhances credibility when presenting it to any third-party stakeholder.
Thank you, Joe. Very, very important points you've raised there about interrogating assumptions and testing these against scenarios. Mark, could you share a little bit about some of the challenges that you've encountered during your time in Treasury?
Thanks, TJ. Yeah, I think Joe makes a good point. There's a fine balance between getting enough granularity versus making it so complicated and so difficult to complete. So overcomplication, finding the right balance in terms of the process is really important. It largely depends on the business that you're in. So I don't believe that any two businesses run in the same way. So it's about the Treasury being able to find the right balance with the information that we've had. There are some companies where you have fairly predictable cash flow, so you can just simply do a revenue forecast. Whereas, as Joe says, there might be some where you have so many different channels that affect your cash flow in a different way. So an FMCG business will forecast very differently, say, from a service provider. One of the other things that we found very difficult is that consolidation tools like HFM and to some extent ERP systems can only give you limited information, and that people may often fall into the trap of thinking, well, the cash flow forecast or the projections in HFM or in SAP or whatever the ERP system is can simply be brought in. And the issue with that we found in practice is that there are often non-cash items in these forecasts which will skew what your forecast looks like. Another challenge is around small teams. Corporate treasuries, as my colleagues will tell you, run with very small teams. So the need to have really good systems can make a huge difference. If you've got a good treasury management system where the forecasting and performance against actuals is measurable in that system, you're going to take away a lot of the manual work that goes around what you need to do in Excel. So start off with your current actuals, look at your forecasts, and build in those accuracy metrics of the 80-20 as Joe spoke about. Thanks, TJ. I think TJ might be frozen.
Yeah.
Perhaps what we can do is, Ovi, over to you, perhaps, just to talk to us about some other common areas of error.
Yes, Mark, thanks. So I think just a lot of information has been covered by Joe and Mark. I think just 2 points that I wanted to touch on. I think what we often find is we need as treasurers to pay attention to the mismatches that we have in the business, different BUs within an organization, or different units that are sitting between jurisdiction. I think this is always a big issue. So lack of information across the business, even across jurisdiction, is quite important. So that information, to the point Mark made earlier, it works well if it is on an ERP and people can access it as in real time, so that when the treasurer is sitting there, which is generally a small team, has easy access to that in real time and they can make decisions on that. It then becomes quite important to ensure that you understand the balances sitting across the different markets, and you can see what is going on in those different jurisdictions, what payments you're making in which jurisdiction and what currency, and all of that information is actually laid out nicely and in real time. And the other important thing that I think we sometimes miss is that if you understand the flow of your payments or cash flows, it actually creates where you have a cross-border engagement or entity. It also creates a nice natural hedge because you can then see what is being paid in dollars, and you leave cash where there is plenty of dollars, and you push those payments into those markets. So those are some of the things that I think we need to just pay attention to, which have shown to be pitfalls for treasury teams in the experience we've seen as a bank. Thanks, TJ. Back to you.
Thanks, Ovi. So let's talk a little bit about some of the solutions that are available out there and recommendations that can be made in terms of addressing these challenges. Jay, let me put this to you first.
Yeah, thanks, TJ. When it comes to possible solutions, it's important to visit and use all sources of information, whether these are internal, external, financial, or operational. By being closer to the operational side of the business, it allows treasuries and treasury teams to understand the key drivers better. The speakers have already covered some of the tips and tricks that we see as possible solutions, but I think it's important to always use traditional sources of information, such as bank statement, historic cash flows, which help spot trends and serve as a useful tool to improve the accuracy of forecasts. And lastly, supplementing the above with real-time data where possible, such as sales plan or payment information, further improves the forecasting process. TJ, back to you.
Thanks, Jay. Mark, what are some of the other things that should be considered as part of the solutioning?
TJ, thanks. Just struggling to find the mute button. I think having the treasurer should be in a position to be able to go across the business and ask why there have been deviations to the plan. What has caused your actuals to vary from the forecast? What did it relate to? Treasurers now are becoming much more integral to businesses, whereas in the past we tended to have been simple functionaries. We're now becoming critical elements in planning within the business. So understanding where the deviations, for example, was it taking advantage of a supply discount, etc. Learning more about that cash flow cycle puts you in a much better position, excuse me, to interrogate and to interpret the forecast going forward. Thanks, TJ.
Thanks, Mark. Now, Kim, in this age of the fourth industrial revolution and with the advent of advanced analytics, what other tools and approaches exist at the disposal of some of the more advanced companies out there?
Thanks, TJ. Yes, many companies have actually started their digital finance journey, and this typically involves the use of advanced analytics. Now, these companies are leveraging data combined with algorithmic forecasting techniques, which incorporate the use of artificial intelligence to really improve their forecasting accuracy. Now, not only is your forecasting accuracy improved through the use of these techniques, but it's also a way of generating enhanced financial insights that you aren't necessarily able to generate through manual processes, and increased transparency, as well as, of course, freeing up capacity to enable employees to focus more on value add analysis. So this is really where companies are moving to, and it's it's really the ultimate solution to be able to essentially click a button and have this information at your fingertips.
Thanks, Kim. Now, given our experience of the COVID-19 pandemic over the last year and a half, I'm sure most of our audience can agree that cash constraints have been a challenge that has been very real for a lot of corporates. And as a result of this, traditional overdrafts have become more difficult to obtain. What other avenues and alternative sources of funding are available to corporates to improve their cash position or facilitate their cash management process? Kim, I'm going to direct this back at you.
Thanks, TJ. So one option, which is not necessarily a quick fix, perhaps more of a strategic measure, is now that many organizations are moving into the recover phase of their journey post-COVID, is looking at working capital optimization. So what that is really taking a closer look at your order to cash, your inventory where that's applicable, and your procure to pay processes, and identifying any easy wins, for example, early payments, lost discounts, delayed invoicing, or non-moving stock, and some of the more medium to longer term improvements, which can be used to improve your days payable outstanding, your days inventory outstanding, and your days sale outstanding metrics. Some of these more medium to longer term suggestions or improvements might include reviewing your terms of trade, looking to move towards just-in-time logistics or single sourcing, and really understanding your manual versus electronic reordering patterns. Looking at all of these processes and really understanding them, we've discovered it can open up quite a bit of additional cash from a working capital perspective. Unfortunately, what we see many organizations do is to take measures to reduce their working capital, specifically at reporting periods. And by doing this, they're really missing out on the longer term cash benefits of implementing some sustainable measures for working capital optimization. After all, working capital has to be financed throughout the financial year, not just at reporting periods. And a significant amount of savings can really be generated by reviewing some of these practices.
Thanks, Kim. Joe, can you speak to us a little bit about some of the considerations around other alternative sources of funding?
TJ, I think it is worth noting that we're seeing an emergence of many new alternative credit finance providers. And for me, it's really just a word of caution that many of the conditions attached to alternative credit may be a direct breach of the underlying terms and conditions of existing facilities. So ensure you're very familiar with the consent and approval requirements in existing facilities before investing the time and effort in progressing alternative credit solutions. We're also seeing a rise in what we term loan-to-own distressed funds. They're on the increase, and what to watch for there is their default clauses need specific attention. A default triggers a conversion of debt to equity and thereby diluting existing shareholders almost to insignificance. So before seeking alternative credit, I would really encourage the use of what I term self-help measures. And Kim has spoken comprehensively on working capital optimization. And for me, that is one of the most obvious self-help measures. It's unpacking working capital. What options lie within your payment terms, your credit terms, your inventory holding periods, for example. I'd exhaust those internal opportunities ahead of exploring potentially very expensive and detrimental external alternative sources of finance. We are also very strong advocates for a cash governance process. So really instilling a cash culture or cash discipline within an organization. The weekly liquidity packs that speak to critical payments, creditor stretch, cash opportunities, decision points on opportunity cost of cash, and an instilled discipline of forecast review, reconciliation, and approval. So ensuring that Treasury is a part of that process is absolutely vital in terms of the cash planning for an organization.
Thanks, Joe. Kim, would you like to summarize then some of these key decisions and considerations that should go into any Treasury's decision-making process when looking at these funding options?
Sure, TJ. So as Joe mentioned, there are obviously internal mechanisms that you can consider before you look for external funding solutions. And I think there really are a number of different solutions from an external perspective that can be considered. And the most important thing from my perspective is that corporates really consider the risks and rewards that are associated with each of these options and pick the most appropriate solution for their specific circumstances. So be aware of trends such as the use of collateralized debt, and don't be tempted to simply follow suit. Really understand what the different options are, what the pros and cons are of each, and also consider or be conscious of the potential costs to Treasury of these different options, TJ.
Thank you, Kim. Ovi, with your banker hat on, can you give us your perspective of kind of considerations that a Treasury function should look to think of when making these decisions?
Yeah, I think thanks, TJ. I think there's a lot of important points Kim and Joe have touched on here, which I think is very important for corporate treasurers to think about. But look, from a bank perspective, the couple of things we need to just unpack there, right? First of all, I think a lot of this is driven by what the treasurer is trying to achieve, right? And I think in the question you were saying, well, ODs are difficult to get. So what can one do in those constraints, right? So one can always look at alternative funding using that balance sheet. And I know that Kim has touched on how important it is to make sure that you're choosing the right product for the right solution that you have as a treasurer, the right problem that you have as a treasurer. So it's important to have the right mix of the products that you are actually using, to the extent that there might be issues, as touched on by Joe, around what you already have and the legal agreements you have, but also in terms of the products you have and how those are helping you optimize your working capital, because ultimately this is about optimizing working capital, right? So if for instance, the treasurer's ultimate goal is a function of, I need to get my cash quicker, then there are options to do that. And if you look at what the banks will always offer you, so think on the working capital optimization things, you're looking at things like supply chain, where you're using your payables to actually extend your days payables, and by providing your buyers with a bit of cushion in there. And there is a very nice element in there, because when you do programs like supply chain, you are actually also making sure that your supply chain is also protected from a sustainability perspective. So there is that. But again, I think the perspective is, what is the treasurer trying to solve for? Now, alternatively, where you're looking at your assets and trying to unlock that cash trapped in those assets, you look at your inventory and receivables and you say, how can I convert this into cash that I can use? But again, we always say that the right mix is important. If I don't need the cash today, and in my cash flow focus, there is no need for cash flows that are urgent today, why would I then do that? And I think it's important to ensure that you always marry that cash need with the kind of solutions you provide. We can do receivable finance, we can do selective receivable finance, we can do so many things there that are using what is already available in your balance sheet. And you can look at your inventory as well and use some form of an IRF, which is stock-backed kind of financing, which are alternatives to ODs. And they tend to be less risky and less expensive from a treasurer's perspective. So those are the things that you look at. And you look at these variations and you find the right mix for the business, which does two things. It allows you to give your buyers space to breathe, but it also helps you to actually create space for yourself to breathe insofar as the payables and are concerned. So those are the things that you can look at. And banks will always show you products, but it's important that the treasurer understands what is the problem that he's trying to solve. Is it a cash flow problem, or is it a sustainability problem? Thanks, TJ.
Thank you, Ovi. Joe, Ovi has pointed out the importance of having the right mix, and companies often have important choices to make between the optimal mix between committed and uncommitted facilities. From your perspective, what are the costs versus benefit considerations of committed versus uncommitted facilities? And what options should companies consider in terms of on and off balance sheet funding?
Thanks, DJ. Camera on. Committed facilities may seem unattractive because of the associated cost being commitment fees. But when we interviewed C-suite executives, reflecting back on those first few weeks of the initial lockdown and the pandemic, and we asked them what their number one response was to preserve liquidity and protect their business, the overwhelming response we got was one of two actions. One was to confirm with their bankers that their committed facility was still in place, or it was to actually fully draw down on those committed facilities to give them the comfort that the liquidity was immediately available to them. So for me, that provided a very necessary insurance policy to trade through those early days in lockdown when, uncertainty was rife. And the opportunity cost of not having a committed facility, granted you do need to have that sufficient headroom in the facility, is the time taken to put additional working capital facilities in place. And in some situations, this time that it takes to put those facilities in place was the difference between survival or failure. So for me, a committed facility did play a very important role in the survival of some businesses in South Africa. And I think, just in terms of touching on potential off-balance sheet financing structures that are available, I think, Ovi and Kim have probably covered that. It's really, for me, I suppose, my closing remark is that you need to understand the business's cash needs. I think Ovi's made that point, and Kim as well. And that any of the products that are available, whether it is supply chain finance, factoring from a debtor's perspective, need to be explored and only utilized if relevant to the business. So for me, it's really utilizing the bank as the partner that Ovi speaks about, not just, approaching them when you think there's a product that you need. Speak to them, understand, unpack. Is this product good for my business? Is it going to provide me with a cash advantage, a cash benefit? What does it give me? What is the cost? Explore that with your bank because they are your partner.
Thanks, Jo. Monique, let's bring you into the conversation. Now, we've spoken quite a bit about different types of facilities, and these facilities obviously come at a cost. Can you speak a little bit about how an entity can ultimately improve its interest line whilst resolving cash management and some of the cash flow forecasting challenges that we've spoken about earlier?
Sure thing. Thanks, TJ. So there's a couple of things that an entity can do to address that. So firstly, we always recommend to clients to centralize their cash and bank relationship management with the treasury function. This has enabled our clients to negotiate the best pricing with the banks on behalf of the whole group, and also puts those with cash management expertise in charge, in the driver's seat of utilizing cash optimally. And by that, I mean, settling the debts, be it short or long term, or investing excess cash at optimal rates and at optimal tenors or terms as well. The second thing also is to clean up the bank account structure. We have to remember that dormant accounts are risky, and also to implement cash pooling. So cash pooling can be done across banks. You just need to arrange it with them. And it's such a useful vehicle for ensuring that the people with the appropriate knowledge have control of the cash instead of it lying around across dozens of accounts, not earning any interest and not readily available to Treasury to settle debts or invest optimally or do whatever the company decides to do. The third thing is make sure that you've got visibility of your cash. This is such a pervasive issue, and you can't manage something that you can't see, right? Unfortunately, often companies don't see the cost of a treasury system and enabling SWIFT functionalities within the bigger picture of the financial and operational benefits that it will result in. But once you've got full visibility of your cash and of your FX, the financial benefits, the savings that it will result in, makes this type of investment pay for itself multiple times over. On the foreign exchange risk side or hard currency side, we often find clients sitting on massive amounts of dollar balances that aren't earning anything, instead of making use of certain instruments to convert it to ZAR and invest it at a better rate until that point in time when you need the dollars again. Often there's also challenges, of course, with FX hedging and hedge accounting, but that's a conversation for another day. The final point that I'll make is that the most important thing is to make sure that you take the business with you and they understand how these costs and savings will be allocated back to them. Once people understand that it's a win-win situation, and by that I mean we're improving overall earnings at the same time as removing a huge amount of operational risk out of the system, the whole journey becomes a whole lot easier. Thanks, TJ.
Thank you, Monique. Now, Monique has raised a very important point around bank relationship management. And we know that healthy relationships are the key to successful growth in most facets of life, and no different in the business world, especially when challenges arise, as we've all experienced during the better part of the past 2 years. In this final part of our discussion, let's shed some light on the importance of the relationship between a corporate treasury and its banks. Jay, from a banker's perspective, what should treasurers expect in terms of what the bank will need from them, and how should they best prepare for these discussions?
Thanks, TJ. To improve on a banking relationship, it's important for treasurers to ask themselves if their bankers understand their business, and more importantly, the funding requirements over the short and medium term. Treasurers have an important role to ensure that these requirements are communicated to their bankers, and this should be supplemented by an honest and upfront discussion with the bankers around the split of wallet. With the impact of COVID, it is now forcing banks to be more considerate around when, to whom, and how much to lend, which brings into focus other non-lending products and services on offer. Banks are now looking to support lending lines with other revenue, so the more information the treasurer can share with the bank, the easier the funding conversations become. Spreading your funding does not always have the most beneficial impact in the short to medium term. By spreading this risk too widely, there's no ability to achieve holistic relationship pricing, which makes it difficult to establish your primary banker. Your banking relationships need to be managed in a very pragmatic manner so that it doesn't destroy value. If not managed carefully, this potentially takes away the power from the treasury in many ways. Portfolio pricing from banks get lost, and each transaction is managed on its own merits, resulting in no or little portfolio benefit. Lastly, it's important to communicate with your bankers early to avoid shocks to the system or unexpected funding shortfalls. Banks want to and are willing to partner with clients wherever possible. Back to you, TJ.
Thank you, Jay. Mark, let's explore the other side of the same coin and turn to you for a treasurer's perspective. Jay has articulated the importance of maintaining that treasury-bank relationship. However, while interests between both sides are often aligned, it should be acknowledged that this is not always a relationship of equals, and the dynamics can vary depending on specific circumstances faced by either the bank or more often the company. How then, Mark, should treasurers ensure that their company's interests are adequately catered for by their bankers and that they get the most out of that relationship?
Thank you, TJ. I think being straightforward with the bankers that you have, first of all, manage these relationships proactively for starters. Treasurers should be talking to their bankers on a regular basis, having discussions on pricing, rates, market conditions, and so forth. And then just be upfront with your banking partners about where your business is and where it's going. Once the bank has a confidence, that the strength of the relationship is already good, that the information that they're receiving is realistic. You're able to approach the bank with confidence. The bank has confidence that the information that you're going to be giving them is a realistic picture, and it will give you that credibility that you need, and will ultimately have an effect on your pricing. It also means that at times of stress, and we certainly found this in past years, if one goes back to the Lehman Brothers banking crisis, that those of us who had solid working relationships with the banks when there was a liquidity crunch put us in a much better position to access funding when we needed it. The banks knew who we were. They knew about our business, etc. Whereas, suddenly painting a too rosy a picture, the bank is not going to be too receptive to that. Just remember as well is that if you're unsure about what you're asking for, the bank is in a position where they're uncertain how to price it, and they might add margin onto the price simply because they don't understand your business fully. So most importantly, proactive relationships. It's a partnership. Have regular discussions on pricing. So as the treasurer, you know what you're going to be in for, and just be straightforward with your banking partners about what is happening within your business space. Thanks, TJ.
Thanks a lot, Mark. Now, I think the audience can agree that this has been a very enlightening conversation. So I'd like to thank the panel. But before we move on to our question and answer segment, I'm just going to go around to each panel member just to get their closing thoughts on the topic, starting with you, Monique.
Thanks, DJ. In terms of closing comments, I think when COVID hit last year, it obviously had a massive liquidity impact, and a lot of clients were scrambling for cash and additional facilities. And this was especially a challenge for clients who were running everything on Excel spreadsheets, who had dozens of bank accounts, who didn't have visibility of their cash and weren't managing it centrally. So it was very difficult for them to assemble very quickly and on a regular basis a clear picture on how much they actually need, and also resulting in unnecessary costs. If you have both cash and debt at the same time, there are some questions that you obviously need to ask yourself. I think we've also learned some tough lessons, and we have to take these lessons forward, right? But ironic to say it, but there really is truth in the saying to never waste a good crisis. We've got to fix the things that we realized should actually have been fixed a long time ago. I think the liquidity issue was also a very strategic opportunity for treasurers to elevate their role in the company and create a better understanding of the key role that a treasury function plays. And hopefully it was also used to obtain the necessary budget and influence and agreement to at least put in place your basic treasury. Thanks, TJ.
Thanks, Monique. Kim, would you like to share some parting thoughts?
Sure, TJ. Yeah, so I think for me, what the biggest lessons learned are really, sorry, are you able to see me? Can you hear me? Okay, I'm going to keep going.
No, we can hear you. Go ahead, Kim.
Okay, cool. Is really an organization's ability to be agile in response to a risk event such as COVID. And that agility is really underpinned by three core capabilities. One is being able to proactively sense or identify emerging risks. Then secondly, being able to translate these emerging risks into different potential scenarios that could unfold. And finally, very importantly, a number of the speakers have mentioned it in this morning's chat, is being able to run those scenarios through your cash forecasting solution to really understand what the potential implications will be for your business. And by doing this, you are able to be more proactive in setting up the necessary management actions that may need to be taken should the event actually unfold. So it's really about being proactive and being able to really pick these things up and get your ducks in a row before it sort of lands on your doorstep and you set into panic mode. Panic mode often results in mistakes and high costs. So for me, those are the capabilities that.
Thank you, Kim. Joe, would you like to share your pearls of wisdom around cash management?
Thanks, TJ. I suppose for me, the most important aspect is really instilling a cash culture and discipline within an organization so that that rolling 13-week cash flow forecast that we've spoken about comes to life. It's a living and breathing tool within an organization. For me, once that occurs, it continuously improves in forecasting accuracy and really does give you that early heads up in case there are challenges. And having that as a discipline within an organization for any future risk events means that you've already mapped a scenario as to what that could look like. You understand the cash levers in the business, what you need to pull on in order to improve your liquidity. Where are the challenges that mean actually we need to go and approach our banking partner to help us address that short-term challenge in headroom in our facility. So for me, cash culture, cash committee, cash discipline, absolutely fundamental in how you manage cash in a business going forward.
Thank you, Joe. Ovi, let's hear from you.
Thanks, TJ. TJ, the couple of things that we need to do in my parting shot, I think I'm going to summarize them in just 2 points. One, real-time information. And I think the point Monique made is so valid around making sure that you pull your cash in one view so that the treasurer can make the right decisions. What we've seen through COVID is that those were some of the pitfalls people got into without understanding what the cash position is in the business, ended up looking for more facilities where they did not need them. So it's important to have that information real time across your operating environments. The second thing, I think we've got to think about the time we spend on risk management. What risk are we managing as treasurers? Use the tools available from your bankers. So to manage your cross-border risk, where you can use some of the old instruments, your LCs and all of those things to manage cross-border risk, use them. Where you need funding, use the best and optimal funding solutions that you need. Because it doesn't help to sit with all these used vanilla, old kind of school thinking facilities where you can actually structure your products in such a way that it helps you optimize your working capital. So that issue around cash and optimizing working capital is quite important. And I think as a bank, I think our view has always been that we provide real-time information to our clients and making sure that they make the right decisions on the needs that they have at a point in time. So be very clear as a treasurer of all of those. Know the cash flows in the entity and have that information real time so that you can make the calls that you need to make. Thanks, DJ.
Thanks, Ovi. Jay, would you like to share your thoughts?
Yeah, thanks, TJ. And I think building on from what all the speakers have said, it's really worthwhile having a real partnership with your banking partners. Sharing relevant information with your bankers allows them to come up with proactive ideas about how to support your business. Banks want to become an advisor to our clients on all aspects of business and can share based on our experience and insights and just the vast client bases that we have. Banks don't only want to be seen as a liquidity provider, but rather a solution provider who understands the business ultimately. Thanks, TJ.
Thanks, Jay. Finally, Mark, can you round it all up?
TJ, thanks. I know I'm probably preaching to the choir here, but I'm certain that when the president announced the lockdown, every CFO asked his treasurer, okay, so what have we got? And what is this? What is our, where do we sit currently? Advocating this should use, as Monique said, never waste a good crisis. Using this opportunity to advocate within your company for the employment of systems. I know that if I was asked on the day of the lockdown and I had a good system where I knew where my cash was, I could confidently say to the CFO and to my stakeholders that I understood exactly what we had and what we needed to do in order to basically remain afloat. So my final word would be use this opportunity, advocate for the use of technology. It's a perfect opportunity to do it. Thanks, TJ, and thanks everybody for listening.
Thank you, Mark, and thank you to everyone on the panel. That was a very, very enlightening conversation, and I do believe that we've all picked up some very important points around cash management, particularly as we recover from the economic crisis induced by the pandemic. Now, to the audience, we've got 5 minutes for questions and answers. So you're more than welcome to give us your questions. via the chat, and we will then distribute them to the various members of the panel to speak to and provide answers. Okay, we've got a question here from Cassandra. Thank you, Cassandra. What are your thoughts on the future of corporate treasury functions, given that there's sophisticated outsourced treasury services available, such as Treasury One? I'm going to direct this question to Mark. Mark, if you don't mind picking this up.
Just repeat the whole question so we can understand it.
Okay. What are your thoughts on the future of corporate treasury functions, given that there's sophisticated outsourced treasury services available, such as Treasury One?
Well, I think the existence of these outsourcing services is it's quite unique, by the way, to South Africa. It's a response to we know that there is a skills shortage. I think these participants can only add to our profession. I certainly think that the corporate treasury profession in South Africa is growing and its relevance is growing. So I only see an upside as far as this is concerned. The profession as it stands is in a growth path, and organizations such as Treasury One and other outsourcing companies are only adding to this because they're bringing to the fore a lot of expertise which companies otherwise might not have seen. So I don't see it as a negative at all. I think it's a sign of growth. Thanks.
Thanks, Mark. I don't know if anyone else on the panel, Monique, do you have anything you'd like to add there?
Sure thing. So echoing what Mark says, completely agree with his points. The one thing I would add is ultimately, even though you do outsource, the risk and the responsibility for proper cash management and proper financial risk management remains with the company. If it is an operational efficiency decision or a strategic decision to outsource, that's a good approach, but ensure that you don't abdicate your own responsibility along with that, because ultimately we remain accountable. So even though we might outsource, it's still really important to understand exactly how everything works, to stay close to the detail, and therefore to work very closely with your outsourcing company to ensure that you're still on top of everything. As Mark has said, if a crisis hits, you do need to know exactly where you stand at all times. So therefore, I think it's a crucial, outsourcing functions are a crucial role player in the market, but it has to be balanced with that responsibility that does remain with the company. Thanks, TJ.
Thanks, Monique. Thanks, Mark. Cassandra, I hope that helps to answer your question. I don't see any other questions coming through in the chat. So I'm going to hand back to Artemis to close for us. Thank you very much for the audience for listening in. Over to you, Artemis.
Thank you very much. And thank you very much to the panel. What a wonderfully insightful discussion, I must say, that many of the people that attended took a lot away with them. So thank you very much, the panel. Thank you very much for all the attendees. Should there be any questions that you'd like to ask afterwards, please send them through to us and we can pass them on to anybody. But once again, the pearls of wisdom were really there, and I certainly hope that you all enjoyed it. So on behalf of ACTSA, thanks to everybody. Take care.
Thank you. Bye-bye.